Do you want to invest with confidence, without researching much, and without taking a look at the companies every 3 months, but at the same time being diversified and see your money grow? If so, let me tell you that that's possible, and I show you in this video how to create a bulletproof ETF portfolio today. Hi guys, this is Jack from the Assets Corner, where you can get all the assets you need to reach your financial freedom. And as I said in the beginning, I'll show you today how to create an ETF portfolio in 2023. So let's jump into it. So first, what exactly are ETFs? ETF stands for Exchange Trade Fund, and that's nothing else than a basket of different stocks, bonds, and commodities. Typically, ETFs track a particular index, sector, commodity, or other assets. But unlike mutual funds, ETF can be purchased or sold on a stock exchange the same way that a regular stock can. To know more about ETF, mutual funds, and individual stocks, you can check this video here where I put a lot of information about that. And when you look for ETF, you will see that there are different types of ETFs. Two typical types are ACC and DIST. The ACC ETFs are accumulation ETFs that automatically reinvest dividends into the fund. This might be interesting for you if you are young, because you will benefit from the compound interest over the years. On the other hand, these ETFs are distribution ETFs that pay out dividends to the investors, so if you want to get cash out of your investments, this is the place to be. You will also see that there are leverage ETFs. Those are ETFs that use derivatives or debt to amplify the returns of the index, and typically they aim for a 2-to-1 or 3-to-1 ratio, meaning if you invested in the S&P 500 and the S&P 500 gained 13% a year, with a leverage ETF you will get 26 or 39%. Sounds good, right? Well, the same happens to the downside, and everything gets a little bit more complicated because returning back your earnings gets more difficult. Here's an example to show you what I mean. Let's say you invested $1,000 and the S&P went down 4%. Still, you invested in the direction daily, which aims for a ratio 2-to-1 of the S&P, then you will have go down 8%. So now you have $920. But the tricky part is, if the S&P goes back that 4%, you go back 8% because of the ratio. Now you have $993 instead of $1,000. So it's kind of tricky. As a general rule of thumb, avoid leverage ETFs if you don't know what you're doing. So ETFs are for you if you want to get invested in the stock market, but you don't want to have the burden of investing in more than 25 companies by yourself. ETFs are also interesting for you if you are trying to diversify your portfolio without buying more stocks. For example, in my case, I try to have 15% of my money invested in small cap stocks. But since I have so many stocks already, and small cap stocks, they are pretty tricky, I just buy regularly an ETF of small caps companies. So yeah, ETFs are an easy way to invest your money and get a nice return out of it. ETFs aren't perfect though. Although they have lower management fees than index or mutual funds, they still have management fees that are up to 1% of your total investment in that ETF, and they offer lower dividends than individual stocks. But you know, in the end, that's a nice price to pay for the flexibility and the freedom you get of investing there. Now let's build a portfolio. But if you like the content so far, don't forget to subscribe, like, and activate the notifications button. So now back to the video. You should have a 50% allocation in established market. I highly recommend the US market because if you like it or not, it is the strongest economy in the world. So go for 25% in the Nasdaq, which is 100 non-financial companies, but the majority are tech-related companies. Another 25% in the S&P 500, which are the 500 largest companies in the US. I recommend the Invesco Nasdaq and the S&P 500 from Vanguard. And I'm not putting the ticker because it changes depending on where you buy the ETF. For example, in Europe, you will have to buy the EQQQ for Nasdaq, but in the US, it's called QQQ. And those are actually exactly the same. There is like a nuance on there, but it's just the same. However, you can get the allocation for the description and look for the ETF you want. Going further, you can put 15% in a World Small Cap ETF. Small cap companies have a higher growth potential than largest ones, and this is a no-brainer. I can recommend the Small Cap ETF from Vanguard, but you can just buy it if you are in the US. If you are outside the US, I can recommend the Small Cap ETF from iShares. Another 15% goes to an ESG Global All Cap ETF. This allows you to invest worldwide by prioritizing companies with good environmental, social, and governance practices. Let me know in the comments what you think about using ESG as an investment strategy. And if you want me to make a video about ESG strategies, the following 10% of the allocation goes to real estate. People usually think that real estate is just housing, but they are wrong. Real estate is everything related to immobility, like houses, but also offices, garages, warehouses, etc. And you'd be surprised by the return of the real estate companies. And finally, the rest 10%, you can use it for a macroeconomic trend, like global clean energy or electric cars. Here is where you can benefit from future trends and innovations. But if you are wrong, you're just losing 10%. And by the way, you won't lose the whole 10%, just a small part of it. So now that you have your portfolio that you can get from the description, now you have to invest your money. And for that, you need a broker. I personally use Trading 212, and they have a robot investor, which is called Pi. And it out-invests every month, so you don't have to do anything. You just have to put the percentage you want to allocate for ETF, connect your bank, and it will invest for you every month. There is a link in the description to Trading 212. And yeah, I get a little something if you use the link, but so do you. So it's a kind of win-and-win situation here. And now, as much as I would wish, Trading 212 doesn't pay me anything for recommending them. I'm just really happy with them. And before we finish, the last question: when to invest? Please don't try to time the market waiting for a crash or something like that. That's a long topic, and I will probably make a video about that, but trust me, it won't work. I invest twice a month, and you should aim for at least once a month. The same goes if for some reason you have a lot of money in the bank or get an inheritance or something like that. Instead of putting the whole money there at one time, aim to put the money at least once a month for at least once a year. That way you won't miss the trends. And of course, this is a long-term strategy. You should keep invested for at least 5 years. As I always say, never give up and try to be the best version of yourself. And if you want, check my playlist on investments for other videos like this. Check out.